Morning, everybody. I think we should probably get going. So this week's guest is Richard Staveley, Brookwood Strategic, which I've been training for a while now. It's done very well last year, UK Small Cap Fund. Bit of news though to cover first. So Scottish Mortgage, of course, I think I couldn't really get away without talking about that again. And then a few funds that seem to have been affected perhaps by what's been going on with the banks. So SVB and Credit Suisse. So starting with Scottish Mortgage. So this is the slide that we put up last week, just when it was all sort of breaking. And obviously MRB Day was talking to the FT and stirring things up. And I wanted to make the point about, it's all very well all of this, but the main thing was this business about the 30% uncredited limit. They need to sort this out. He's been sort of dripping more stuff into the media as we've been going on. So in today's FT, there's a quote that says basically that he thinks that buybacks for funds that hold illiquid assets shouldn't really be allowed. That seems to be the implication of what I think he's saying, which I completely disagree with for various reasons, and we'll come on to those in a minute. On Wednesday, he told the Times he was going to start handing over the board papers to the FCA. On Tuesday, he said that there was a whole bunch of procedural violations in the boardroom, and he questioned the fact that Fiona McBain had been there so long, to the point he said that she was sort of a vicious stooge for the managers. All sort of heady stuff. He was still a director when we were talking about it last week. There was a lot of confusion about this. I think he thought he wasn't, and the board said he was. That's what they said at the 4 p.m. By the time we get through to the 21st of March, though, he definitely wasn't. Whether he was resigned or they kicked him out, it's not clear, but there we go. But they also announced, obviously, a whole raft of other changes. So after 14 years, the chair will step down at the AGM, and so will Paris Ibaki, who's been on the board for 9 years. Amar's been kicked off. So of the original 6, we're down to 3. Justin Dowdy goes up to the position of chair. Patrick Maxwell takes on Justin's role as senior independent director, and they're going to need a chair of the audit committee. So that's the sort of picture we put up to accompany our news story. So basically, it's just these 3 left. Now, one of the things that Amar brought up was the fact that the board is lacking with directors with professional investment experience, and I think we definitely agree with that. So the new chair is an accountant and investment banker and chairing the takeover panel, but he's not been investing money. Mark Fitzpatrick is really an auditor, but he's actually now group CEO of Prudential. Nevertheless, sort of, it's not the same thing. Patrick Maxwell is an academic, although he has done quite a lot of biotech research. And so sort of real world stuff. And of all of them, I think he's the one that I'd be most keen to keep on the board. There is this gap, though, in terms of the lack of investment management experience. And if it was me looking at the original board and thinking what needs to change, the first one I would have kicked off probably would have been MRB Day, because it just didn't need 3 professors and probably not somebody of his background, I think. What's left, though, the 3 remaining directors, they do have a diversity problem. There are rules now which they're not completely cast iron, they're comply or explain, but really for a fund like this, if they didn't do it, they'd be in trouble. They need at least 40% women directors, so they need to appoint at least 2 more. One of those needs to have a senior role. So Justin's already got the top job. So that would imply that one of those would have to become the new senior independent director. Now, we've talked about this before. I don't completely agree with this particular position. I think chair of the audit committee ought to count as a senior role. At the moment, it doesn't, but I think it should do. And the other thing is that based on the Parker review, they should also have somebody from a non-white ethnic minority background. So they need to address all of that, as well as addressing the kind of deficiencies in experience that they've got. So we'll see what happens. I'd rather they took their time and got that done properly than sort of rushed it. I think one of the stories that Amar was reporting on was that all of the people they'd approached for roles were actually academics, which again just doesn't make any sense to me. They do need somebody with some more kind of real world stuff. Baillie Gifford's counter to this has been quite muted so far, really. James Budden did talk to TrustNet. He's the marketing guy there. And he stressed a few things that are quite sensible, really. One is that Scottish Mortgage's private holdings are not in little, illiquid, early stage venture type things. They're in really quite chunky companies for the most part. And most of them, as it shows you there, are more than $2 billion, that should be, in size. So they tend to be quite big, sensible companies. Because of that, it's not Baillie Gifford's role to get actually involved in the day-to-day management of these things. And so therefore, the original comment that Amar made about the lack of depth of expertise at Baillie Gifford on this is irrelevant. They're not a venture capital investment firm. That's not what they're doing. They're not doing the same thing as many of these other VC firms would do. They are providers of finance. That is their main role. So it's not really an issue. The other thing that he stressed is that the valuations of the unquoteds are pretty much up to date. They're all signed off by the board. They're all informed by sort of independent third parties as well, where that's necessary. And they're all done on a rolling 3-month basis. So I think this is what negates the idea that you can't buy back the stock because you don't really know what the NAV is. Either there's something fundamentally wrong with the way they're calculating the NAV, and I don't disagree with that, and I disagree with that, sorry. Or what I'm saying is that the NAV must be right. It must be right. Otherwise, it doesn't make any sense. This, though, is the problem that they've got. So at the end of February, almost 30% again of the portfolio was in unlisted private companies. And they also got quite a lot of gearing. And that's obviously because the value of the quoted portfolio has fallen. And both of these now are acting as a constraint on buybacks. And as you know, I think the discount's way too wide and they need to address that. So I've been saying for a while they just need to be a bit more aggressive about this and maybe raise the unquoted limit. Now I'm thinking that actually a better idea might be for them to actually just trim the private exposure. They won't want to do that. They'll moan about selling it too early and giving away value. But the fund is shrinking and does need to shrink further. And I think if they could demonstrate the value, the NAV, by selling something at or above the value is in the NAV, then that would reassure investors and it would free up the cash to pay down gearing and fund buybacks. So that would be my preferred solution now. But we'll wait and see what happens. Now, SVB Credit Suisse. These are the 4 funds that I've picked out that seem to have some kind of direct exposure to all of this in one way or another. And here's some charts for them. And you can see that they're all affected in different ways, but EJF, the share price had a little dive there. Axiom European Financial Debt, same thing, and the NAV came down too. BH Macro, not a lot going on yet, and definitely after such a great run. I mean, it's barely noticeable, but we'll come back to it second, and trading at premium still. Polycat Financials, quite a big drop now, taking it all the way back to levels of 2018, 2019. I think that's probably overdone. We'll come on to that in a second as well. So EJF is invested in securitized positions. So we talked about this before, but basically you take a package of loans or debt and you sell off interest in them in tranches. The senior tranche is the most well protected and has the lowest rate return. The equity ones at the bottom take the first hit if anything goes wrong within the portfolio, and they're the ones that EJF Investments hold. So it didn't have any exposure to SVB when all of this kicked off, but it did actually have something in December. Now it's not obvious to me when that was sold, but they might have sold it just before it all completely hit the fan. They were exposed to Silvergate, which was the bank that went down because it was exposed to crypto, and that all kind of fell over. On a look-through basis, that was 2.5% of the portfolio. But because these things are all geared, as I say, because the equity safe first hit, the hit to the NAV might have been bigger than that, perhaps a lot bigger. We just don't know yet. There won't be an NAV announcement for about 4 weeks. So on the 21st, they announced the NAV at the end of February. So I think we're talking probably about the 21st of April before we get the NAV as at the end of March. So that, I think the jury's out on that one. Even though it looks very cheap, it's on more than a 40% discount, I think I'd be slightly wary about climbing in there. It may not be as cheap as it looks. Axiom European Financial Debt, it did actually have some exposure to the Credit Suisse additional tier 1 bonds, the thing that got wiped out, which has caused all the row. The NAV did go down. It's not particularly material. It's quite very well diversified, which obviously helps. And the NAV has actually bounced because regulators all around the world have said, we wouldn't have done what the Swiss financial authority did, but basically the first people that should have taken the hit and then something becomes a disaster would have been the equity and then the additional tier 1 bonds underneath them. The way that the UBS takeovers worked is that the equity has got more than 3 billion, but the AT1 bonds have been wiped out. That's going to all get resolved in the courts. That I think the Swiss haven't got a leg to stand on. And there's some articles about it today. It's only really happened once before in Spain with Banco Popular, and it all sort of made more sense. This doesn't really stack up. So on the basis that everybody else has said we'd never do this, it's just the Swiss, and we're into at UBS now. 81 bond prices have bounced back up again. And the manager of this fund is actually thinking that the things that he's invested in are looking quite attractive because, as we've labelled before, banks do make more money when rates go up because there's more opportunity. There's for them to take a bigger gap between what they're paying for deposits and what they're lending out at. And so he's quite optimistic, but back in August last year, the board had already decided that really this fund wasn't working and its job was done. So they will be looking at returning cash in that fund fairly soon. We should get an announcement, I think, within weeks about how they're going to liquidate that, or maybe measuring something else, but more likely liquidate it. BH Macro, I wouldn't have thought this was an issue, but performance hasn't been great this month. We've only got the NAV as at the 17th of March so far. So before that really sort of got bad. But there was a story in Bloomberg that they stopped trading with some of their traders because they hit their maximum loss levels because of what was going on with volatility. So there may be a hit to NAV. We won't know what that will be until I think the 28th. So the 28th of March, we'll find out what the NAV is as it plays a play tonight. Generally, though, I think there's a chance they can make it up. As we've seen, the really good performance there, volatility is what they thrive on. And so all of this is creating volatility, and that should be good news for them. And lastly, Polycap Financials, which seems to be hit hardest, but I think it's completely unfair, really. They've been very good about buying back stock, so they've kept the discount narrow, which is good. They were also very good about making sure they weren't exposed to these dodgy banks in the first place. So they didn't have any exposure to them. They did have some exposure to smaller US banks because they saw an opportunity for more consolidation there. But that's been trimmed. And they've also repositioned some of the portfolio where they were worried that perhaps there would be some kind of read across and things might get hit. They're particularly cautious about banks exposed to commercial real estate, and so they've done something about that. They think those AT1 bonds are cheap too, just like the Axiom managers did. So that I think they may have put some in the portfolio, but it won't be mad. Maybe. So I think actually that one's probably set to recover. How quickly it does, I don't know, but given what's going on with banks and the profitability is going up, I do think that that might be actually quite an opportunity for this one. So that's enough for me.